Hi, ladies and gentlemen. Welcome back to the Advanced Mortgage Solutions podcast. We've got our special guest, Greg Miller, today. Welcome back again, Greg, for second podcast episode. Great to have you here.
Yeah, thanks for having me, Joel. Nice one.
Awesome. Hey, look, on the previous episode, we spoke about the Kainga order product available, but now we're going to pivot and talk about the other options when you only have a low deposit. So if someone may have a 5%, 10%, 15% deposit and not quite hit that 20% deposit, around what the options are available to those people.
Look, there's certainly low deposit loans out there for exactly that type of customer for sure. Okay, so lenders in New Zealand are restricted by the Reserve Bank of New Zealand, where, if you like, a bank can only write so many loans with less than a 20% deposit before they start to run into restrictions. So the lenders are restricted by the number of the low deposit loans they can actually write. And in the previous podcast, we were talking about the KO loan. Now, that one is exempt. So a bank, as long as they can do the KO loan, not all banks do, that's an unrestricted loan. They can write as many of them as they want. But what we're talking about here today, Joel, is we're not talking about the KO loan. We're talking about a sub 20% deposit loan, which isn't the KO loan. So generally speaking, we can go down to as low as a 10% deposit.
Right.
BNZ does have a 5% deposit for existing customers. There's some quite heavy criteria around that, but that's still an option that we could look at. But generally speaking, the lowest deposit that we could go to is 10%,
right?
Unless it's a KO loan, of course. So, basically, with that, as long as you have between a 10% and a 20% deposit, the lender would be willing to look at that as long as they haven't come up towards their restrictions, i.e. they're starting to write too many of them for any given year.
I see. That makes sense.
So,
yeah.
So they are looking for strong applications.
Yeah.
Even though the deposit might be low, a strong application in terms of servicing or low debt would certainly help our cause to get a loan down in that low deposit zone.
When you're talking about servicing low debt, you're essentially saying someone's income ability to pay the loan off. What are they earning per annum? How much can they afford to pay down? And then the debt, I'm assuming you're talking about minimal credit card debt and other personal loans, that sort of thing.
That's exactly right, Joel.
Yeah.
That's exactly right. So, it's always good to, present an application with as least debt as possible.
Yeah.
If there's sort of a whole lot of car loans in there and then, sort of loans to other family who they're paying off, then, we can still mitigate those things out, but perhaps it's not as strong. In the low deposit space, the banks are looking for those stronger applications because there is a limited amount of these loans that they can actually write.
Yeah.
Okay.
So Greg, tell us a little bit about, in our last conversation, you mentioned that these products attract a higher interest rate, and also something you mentioned, loading, which I'm assuming is some type of fee. Do you want to explain what the loading actually is and then what to expect from a higher interest rate point of view for these, low deposit products?
Yeah, so look, it's a bit similar to what we were talking about in the previous podcast there, Joel. Look, so any loan with less than a 20% deposit will attract a premium, and that's because that loan has to be insured. The bank has to insure that loan because it's deemed to be high risk. So the lender, one way or other, will eventually inevitably charge the borrower for that fee. So in this instance, when it's not a KO loan, generally speaking, they'll pass that cost on by putting loadings on the interest rates. Right. So typically speaking, if somebody had between a 15% deposit and a 20% deposit, not quite at the 20, but 19.9. If they were there, then they could expect to attract a premium somewhere around sort of 0.25. So
Right.
they would get sort of, they might not get the special, the slightly higher rate than the loading.
Yeah.
Now, if they had a less deposit, so now we're talking between sort of 15% or 14.9 down to 10, so it's become higher risk load. That loading typically goes up to 0.75. Okay, so that's quite a jump.
Yeah.
That
Yeah.
is quite a jump. So, the applications need to be strong here generally in terms of the servicing, because
Mm.
the assessment of these loans is a little higher
Yeah.
in terms how it's assessed, because we need to understand their ability to pay these higher interest rates,
Yeah.
if that makes sense.
Yeah.
It's,
Makes
it's,
sense.
it's important
Mm.
that these rates do apply, but this is the way that the bank will get that premium back off the
Yeah.
customer.
Yeah. That makes a lot of sense. Yeah. Look, and then if someone was, say, coming in with the, say over 15%, let's just say 16%, and they had that 0.25 additional on top of their interest rates that they could
Yep.
achieve and the loading, how does someone, you know, get rid of the loading as quick as possible? Does the loading stop at some point of time, or when does it
That's a
change?
that's a really good question, Joel.
Mm.
So look, the loading will effectively be lifted, and then the borrower will be given the special rates, the very, very low rock star rates that I like to call them. They'll be given them once they get up to 20% equity in the property. So that's
Right.
similar to sort of putting down a 20% deposit at the
Yeah.
beginning, if that makes sense.
Yeah.
So that means that they now own 20% of the property, and the bank is lending the other 80. So
Right.
once they get to that stage, the loading can be lifted,
Yeah.
and then the borrower can expect to get those high street
Yeah.
rock star rates, as I like to call
And,
them.
and so can they like renegotiate the rate straight away? As soon as they hit 20%, can they just flip the rate, go to the bank and say, look, I want a lower interest rate now? Or how does that part work?
Yeah, look, absolutely. So, there can be sometimes, unfortunately, a bit of argument around this. So,
Oh, yeah.
where the borrower might feel that the
Yeah.
property has gone up in value
Yeah.
more than what the bank
True.
thinks.
True.
So,
Yes.
look, that
Mm.
sort of thing can happen. We can return to that, Joel. But
Mm.
look, to increase the equity in the property, to get there as fast as possible, is obviously, try and reduce the loan down as quickly as possible. And look, we can look at various options through line of credit facilities, offsets to help achieve that, to
Yeah.
get that loan amount down. The other thing is to, maybe make improvements to your property, which may increase its value also.
Yes.
Okay. So,
Yes.
basically you're reducing your debt, which
Yeah.
is increasing your ownership, and then you increase the value. Or alternatively, the property will increase in value naturally anyway.
Yeah.
So the debt comes down, the value goes up. Your equity as the borrower increases.
Yeah.
And then you have maybe you put a new bathroom in it, the fifth thing.
Yeah.
But this is where the arguments can start, Joel, because
Yeah. Yeah.
the bank is completely unaware that there's a brand new kitchen and bathroom in
Yeah.
there. So,
Yeah.
look, what will happen
Mm.
is the bank does what is called a top valuation, or IVAL.
Yeah.
And this is where they have a whole lot of parameters available to them. It all gets put into their system, and their computer will basically spit out a number of what they now feel that property to be in terms of value.
Right.
So then
Yeah.
it's a very simple calculation for the bank, the value
Yeah.
against the debt. That's
Yeah.
going to give you the LVR, the
Yeah.
equity position.
Yep.
And look, as long as that is 20% in favour or more to the borrower,
Yeah.
they are happy to
Yeah.
to take those loadings on.
Yeah.
One thing there, Joel, is that what a lot of people don't realise is that loading can actually only be lifted at the end of a fixed rate period. So if somebody has
Yep.
sort of fixed in maybe sort of 4 years,
Yeah.
it is established at the 3-year mark that they now have 20% equity in the property. unfortunately, they're going to have to see out that other year paying that loading. So
Yeah.
loadings can typically only be at a fixed rate rollover.
Right. Well, that makes sense. It's just like a standard loan too, isn't it? I mean, you can break it or change it, but then you've got break fees and all that sort of stuff to consider. So it sounds like there's sort of three ways that you can get to that 20% as quickly as possible. One is your natural, increase in the property valuation, which just seems to happen in New Zealand. We're lucky every cycle, or
100%.
Secondly is choosing to add value to the property yourself. So, for example, you buy a 3-bedroom, you could add a 4th bedroom in, for example, little tweaks or as you said, bathroom sort of things. And then thirdly is just good old paying the loan down as quick as you can.
Paying the loan
right?
down. That's it. That's it. And we all want to do that, right? We all want to pay down as fast as we can.
Yeah.
And like I said, look, we're more than happy to, have detailed conversations with our clients and how we can do that as quickly as possible.
Yeah. All right. Well, look, thanks for the tips today, Greg. For those that are listening and watching, if you want to get hold of Greg, book an appointment, which is free, by the way, or with one of the other team, just go to www.advancedmortgagesolutions.co.nz, fill out one of the web forms, pick up the phone number on there, 800 number, and the team will look after you.
Perfect.
Thanks, Greg.
Thank you very much, Joel. Enjoying it, mate.
Cheers.